Hello everyone. So in today's video we're going to discuss a topic asked in Prelims 2016 called Masala Bonds. What we will also do is that towards the end of this video we're going to discuss the question which is asked in Prelims 2016. So let's get started and understand the concept of Masala Bonds. So Masala Bonds are basically a special type of bonds because these bonds are issued outside of India, but despite that, these bonds are denominated in Indian rupees. That is, these are a special type of bonds which allow different Indian entities to borrow from abroad using the Indian rupees, and they allow Indian entities to borrow without using foreign currency. Now, the reason why this is beneficial is that before masala bonds were introduced by India, any entity which is borrowing from abroad, be it a bank or a company, always was exposed to a foreign exchange rate risk. Now, what is a foreign exchange rate risk can be understood by looking at the example out here. So let's say in 2024, HDFC Bank wants to borrow 1 million US dollars from abroad. So basically, if HDFC Bank is borrowing 1 million US dollars in 2024, when the exchange rate is 1 USD is equal to, let's say, 70 rupees, then basically HDFC Bank is borrowing 7 crore rupees in 2024. Now let's say HDFC Bank decides to pay back that amount in 2025. However, in 2025, the rupee has depreciated against the dollar and now the rupee is 75 against the dollar. So in order to pay back that 1 million USD which HDFC Bank had borrowed, it will have to pay back 1 million into 75, that is 7.5 crore rupees. So what you can clearly see out here is that the depreciation of the rupee has increased the cost of borrowing in foreign currency. So clearly out here we can see that HDFC Bank is required to pay an additional 50 lakhs merely because the rupee has depreciated against the dollar and HDFC Bank had borrowed in US dollars. So what masala bonds allow is that they allow Indian entities to borrow in local currency and thereby protect themselves from the risk of foreign exchange rate fluctuation. So that's the first and key benefit which masala bonds provide. In addition to that, masala bonds also provide certain benefits to the economy. So the first benefit is that they help with the internationalization of the rupee. Now, the reason why masala bonds help promote the internationalization of the rupee is that any investor who wishes to purchase masala bonds will have to sell foreign currency and buy local, or will have to buy Indian rupees because the borrower is borrowing in rupees. So that's why this increased international demand for rupees helps promote the global acceptance of rupee, or it helps internationalize our rupees. So that's the first benefit which masala bonds provide. The second benefit is that they help reduce the pressure of depreciation on the Indian rupees. Now this again happens because as masala bonds help increase the demand for rupee, and we know that when there is an increased demand without a corresponding increase in supply, it helps either appreciate or reduce the pressure of depreciation on the currency. So these are the two additional benefits which masala bonds provide to the economy. Now, if you talk about masala bonds were first introduced in 2014 by International Finance Corporation. So IFC is a part of the World Bank Group, and it introduced masala bonds in 2014 so as to promote infrastructural development in India. So in order to support infrastructural development, IFC, which is a part of the World Bank Group, issued masala bonds for the first time, that too in 2014. Now the word masala was prefixed to these bonds when they were being issued by IFC, because IFC wanted to reflect the distinct Indian culture and identity. So the word masala would help an investor clearly distinguish these bonds from other bonds and clearly understand that these bonds are meant for India, or they meant for investment purposes in India. So in order to promote that distinct Indian identity, the word masala was prefixed to these bonds. So similar to India, you have several other countries which issue bonds in their local currencies. For example, you have the dim sum bonds, which are used to borrow in Chinese renminbi, and they are issued by China. Similarly, you have the Komodo bonds, which enable Indonesia to borrow in Indonesian rupee. So like India, you have several other countries which issue bonds to borrow in their local currencies. Now, if you talk about which all entities in India can borrow by issuing masala bonds, so both public as well as private entities are allowed to borrow via masala bonds. So basically a host of entities, for example, you can have government bodies such as NTPC, or you could have public and private banks such as HDFC. You could even have non-banking financial companies issuing masala bonds. In addition to that, there are corporates which can issue masala bonds, and then you can have investment trusts, for example, real estate infrastructure trust, and then you could have investment infrastructure trust, and a host of other bodies which are allowed to issue masala bonds to raise funds for different objectives, such as you could have entities issuing these bonds so as to promote infrastructural financing or to promote infrastructural development. Similarly, you could have these bonds being issued to meet social objectives such as affordable housing. Similarly, you could have, let's say, a company issuing masala bonds or borrowing via masala bonds to refinance their existing rupee loan. So let's say a company borrowed in India at a higher interest rate, and it could borrow via these masala bonds at a lower interest rate so as to pay back the earlier loan. So they can be used to refinance the existing rupee loans as well. Similarly, you could have entities using these bonds to finance different capital requirements or objectives they might have. For example, you could have a corporate issuing these bonds so as to fund the building of a new factory. Similarly, you could have a bank raising funds via these masala bonds so as to ensure that it is meeting the capital regulatory requirement of RBI. So different entities can borrow via masala bonds to meet the different capital objectives they might have. However, masala bonds are not allowed to be used for two specific objectives. That is, they cannot be used for investing in the capital market. That is, you cannot use the proceeds from these bonds to speculate in the stock market via shares, derivatives, and so on. Also, these bonds cannot be used for real estate purchases, for example, purchasing of land. So these are the two things for which masala bonds are not allowed to be used. Now, if you talk about the minimum maturity requirement for these bonds, so if you have masala bonds which are issued up to USD $50 million equivalent, that is, if any Indian entity is borrowing via these bonds up to, let's say, 480 crores, given the current exchange rate of 95 against a dollar, then the minimum maturity of those bonds should be 3 years. And if someone is borrowing more than $50 million equivalent in rupees, then the minimum maturity should be 5 years. So that is the minimum tenure for which these bonds can be issued. So this was the basic understanding in regards to masala bonds. Now let us discuss the question which was asked in prelims of 2016. So in 2016, you had a question which said that with reference to IFC masala bonds, sometimes seen in the news, which of the statements given below is or are correct? So the first statement was that the International Finance Corporation, which offers these bonds, is an arm of the World Bank. The second statement was they are the rupee denominated bonds and are a source of debt financing for the public and the private sector. So take a minute, pause the video and think about which of these statements are correct. So clearly, if we look at the first statement, as we've discussed in the video right now, IFC was the first organization and which is an part or an arm of the World Bank which issued these bonds in 2014 so as to promote infrastructural development in India. So that's why this statement is clearly correct. Now, if you talk about the second statement, they are rupee denominated bonds. That is in fact the key defining feature of these bonds, and they can be used for debt financing or meeting the capital requirement both by the public and the private sector. So we've clearly discussed both these statements in the video so far, and both these statements are correct. So the correct answer is C, that is both 1 and 2 are correct. So this is all we wanted to cover in context of Masala Bonds. I hope you liked this video. If you did, follow the channel for more concepts in regards to UPSC economics. Thank you so much for watching.